Here we are. We have the perfect storm of inflation fought with a deflationary recession and geopolitical risk that's led to de-dollarization. None of those things bode well.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Matthew Piepenburg from Matterhorn Asset Management. Matthew, thank you so much for joining us today.
Well, it's great to be back. Looking forward to talking.
Definitely, and we're recording this the day after the Fed rate hike of 0.75%. So now the Fed funds rate stands above 2%, right around 2.5 and 2.75%. Your take on how the markets reacted? It was kind of interesting. It seems like, I think they were relieved that it wasn't a full percent there, but we actually saw gold and silver rally and the stock market rally.
There's a lot happening yesterday and in the next few months and years. Certainly, it was a very interesting FOMC meeting in the sense that there was a kind of bipolarity to it. It was hawkish and dovish in the same event, in a sense. And it kind of is no surprise to me because it represents Powell's confusion and bipolarity on being hawkish with a rate hike. Even 75 bips is still hawkish, not 100 bips, but it's still hawkish. And yet the press conference discussions afterward, he's very dovish, saying, look, we were talking about consistent monthly rate hikes, or at least 11 rate hikes are getting to 3.8% by 2023. I've always said that's never going to happen for a number of reasons. But yesterday, he basically indicated that because of, slower growth or softening growth was the word Powell used, that we're going to be more careful in the future and we're going to be data dependent and meeting by meeting analysis of whether we'll continue to raise rates. So that was a very dovish postscript to an otherwise hawkish policy move yesterday. The markets had already priced in at least 75 to 100 basis point rate hike. But again, this combination of being hawkish and dovish sent them very mixed, but ultimately, I think, tailwind to the markets in general. Risk assets, once again, thought, well, bad news is good news, because if the Fed is talking about slowing growth, that means they're going to be easing rather than tightening. That will be a quantitative easing, probably tailwind for markets longer term. And so there was a risk on rally. That's not uncommon in general. Usually you see rallies the day of the Fed meeting because some bad news is in there that makes the markets feel the Fed will be easing down the road. They'll rally, and then usually the next day or two, they'll fall off. Gold and silver, precious metals went up because that dovish postscript about maybe looking at things more differently because of softening growth, that indicated that the Fed was going to be less hawkish. So you got this classic mix of hawkish and dovish sentiment coming out of the same meeting. I think that, again, is a symbol of the central banks in general and the Fed in particular are truly caught between a rock and a hard place, because they know they have to optically raise rates to, quote unquote, fight inflation. And yet they know that if they raise rates too high, that's a disaster for the markets, a disaster for the national government, because that makes the cost of their interest expense or their debt IOUs more expensive. So rising rates too high is painful to the markets and to Uncle Sam. And yet if they continue to be too dovish and continue to ease and continue to buy back U.S. treasuries and even mortgage-backed securities and do the QE to infinity, that's highly inflationary. So they're stuck between this rock and a hard place. And yesterday's meeting was kind of, again, very indicative. It was a representation of that confusion, and markets are confused. They're rallying into what is really a rate hike, and yet there's this belief that the Fed will return to its old ways and be very supportive and accommodative of the markets. And so, again, not a surprising a rate hike, and yet I think the postscript language, because everyone's watching the markets, is looking at the math and the adjectives. So there's math and grammar and these magical words that Powell uses that people have learned how to translate. And as our colleague Ronnie Sturfill has said, the rate hike will probably go down in history as the shortest ever lived for a number of reasons. Growth is slowing down in the U.S. and slowing down internationally, so rate hikes are not good for growth. governments can't afford, or the U.S. in particular can't afford rising rates. Even the inflation affecting on fighting inflation with rising rates, that still doesn't counteract the fact that we're doing more government spending. And the fourth point is markets are already priced in a rate hike. So there's a lot of reasons why the rate hikes that are making all the headlines right now, I believe, are very short-lived. And this notion that we're going to get to 3.8% by 2023, I think is mathematically impossible. And depending on who you listen to, whether it's the Washington Post or I think it was Rick Chekin over at Asset Strategies International said the other day that if you just go one percentage point up in interest rates, the cost of servicing that debt is $28 million a day for the Fed, or for the U.S. government, $28 million a day adds up month to month to month, quarter to quarter. That becomes unpayables. So again, the Fed really mathematically can't afford to be Volcker-like and raise rates to fight inflation. And at the same time, they know that if they go back to quantitative easing into infinity, they're going to be debasing the currency. So that's this confusion. Markets are confused. Gold and silver will rise on a dovish sentiment if that means more support. But, I think, again, the math of our debt doesn't allow us to pretend that we're Paul Volcker. I mean, Powell is embarrassed for his own personal legacy. We have to remind you that when Volcker went 1,000 basis points in the 1980s to fight inflation, the debt to GDP ratio in the U.S. was 30%. Today, it's over 125%. So we can't be Volcker. And we really can't fight inflation. When inflation year to year, year over year is 9.1%, even a 3% or 4% Fed funds rate is not going to beat inflation. The only thing they're using to fight inflation right now, I think, is a strong dollar, because that means imports cost less. When a German toaster comes in and the dollar is stronger, it's cheaper for Americans to buy those things. But when you have a stronger U.S. dollar, that makes our exports more expensive and it adds to our deficit. So there's really this confusion, this no good scenario left area where the Fed is caught right now. And yesterday was another example of kind of sending a mixed message that was both hawkish and dovish, bearish and bullish, depending on how you want to look at it. But I think the ultimate result yesterday is the markets thought bad news is good news. We've got inflation, we've got slowing GDP, we're heading into recession. Powell's going to pivot sooner than we think. And there you have a rally. So interesting day for sure.
It does seem like the Fed is trying to kind of thread that needle, right, between being too hawkish and too dovish. But I don't see how that's really possible at the end of the day, as you mentioned, because I mean, math is math, and if the Fed has created all this money and stimulated the economy this way, it has to come back as inflation. There's just no way out of it. And as you mentioned, it's not like we're not in a situation where we were back in the 80s, where Volcker raised the interest rate above the rate of inflation. We just can't do that anymore to get inflation under control.
Right. No, again, and this goes back to another theme, which I think is not really being touched upon enough in financial media, mainstream or otherwise, is what really is the inflationary goals and what really is the policies of the Fed. I mean, the central bank looks, like you said, like it's running uphill in roller skates, trying to be hawkish and dovish. There's a reality of inflation we can't fight with interest rates. We're not in the Volcker era. We have way too much debt and growth is slowing. I think when I look at inflation and how it's reported in terms of real rates on the U.S., the real inflation adjusted rate of the 10-year Treasury, which is the real yield, and how they measure inflation on the CPI scale, how they report inflation, how they fight inflation is so completely fudged math. And we can get into the weeds on that in a second, but there is a sense of kind of Al Capone's accountants, the way they report inflation, the way they report inflation adjusted yields and rates. It's really creative math, and I would say dishonest math. But before you even get to that, the CPI scale and the way the Fed reports real interest rates, you have this reality that because we're in debt, the Fed actually wants inflation. They have to optically fight inflation with rising rates when we know at 9.1% year-over-year inflation, rising rates aren't going to fight inflation in a real level. So why are they pretending to fight inflation when they know that it's not possible that way? Because deep down, I think the central banks of the world, and the Fed in particular, are seeking inflation. And that sounds like a blasphemy or a tinfoil-hatted notion, but it's just as old as history itself. When you're in debt up to your ears and then some, you inflate away that debt by debasing the currency. The Fed wants to have its cake and eat it too. It wants to say it's fighting inflation with interest rates, but it wants negative real rates. It actually wants inflation higher than rates in real time so that they can inflate away some of their debt. So they'll propose publicly to be worried about inflation, and yet they'll want inflation. But one way to say that they're fighting inflation is to raise rates. And then in the meantime, they will misreport actual inflation so they can have their cake and eat it too. Of course, we feel it. We feel inflation on the streets, in our grocery stores, at our gas pumps, at our, like I used to say, the George Washington Bridge. You feel it everywhere. But the Fed will still tell you that 2 + 2 = 2. And there's two key ways they do that. The CPI scale that measures inflation, as I've said before, is a broken scale. That's a known secret. It's not a gloom and doom theory. It's just a fact that we're really at more closer to 18% inflation using the CPI scale that Volcker used in the 80s. We're really at 18% inflation. We reported at half that. So that's one way we lie about inflation. And the other thing is when we talk about negative real rates, well, if you have a 2.9% yield on the 10-year Treasury, and then you subtract inflation from that, you should have negative real, inflation year over year at 9.1. So inflation adjusted yields on the 10-year Treasury are negative 6%, negative 6.2%. So we have negative real rates just using year over year inflation and the yield on the 10-year. Real simple math, negative 6% rates. And yet the Fed will tell you instead of negative 6% rates, we have positive +1 real return on the 10-year Treasury. How do you go from negative 6 to positive 1? With the same calculator? And it comes down to, again, this fudgy little math that they use the Bureau of Labor Statistics and the Fed and the Cleveland Federal Reserve, where they can make 2 + 2 = 2. And they basically stretch out the yield on the 10-year using inflation expectations and deflation and empirical models and surveys. In short, a lot of reverse engineering to report real rates in a way that are not actually true. And I know, again, that sounds like an apologist, conspiratorial theory, anti-American. No, it's just true math. If you have year-over-year inflation at 9.9% and you've got a yield on the 10-year at 2.9%, you have negative real rates. And that should be a huge tailwind for gold and a real threat to the Fed and the central banks. So they simply misreport the math. The truth is they want inflation to inflate away debt, and yet the only real tool, the only real option when you have this kind of runaway inflation that we're having now, which existed prior to the war in the Ukraine and existed prior even to COVID, there was already rising inflation, misreported but rising. Historically, in addition to trying to inflate away your debt by debasing the currency, which is what the Fed has actively been doing and misreporting real inflation, the only real option to fight inflation is a recession, because a recession is inherently deflationary. There's lower growth, lower demand, prices come down. You have to stall the economy, and that is stagflation. We'll have inflation and lower demand in a recession. And you're seeing that because even Powell says softening growth. What he doesn't want to say is we're officially in a recession, because we could have 2 back-to-back quarters of negative GDP. But already you're seeing Powell, Yellen, and Biden and others trying to redefine what a recession is. Well, we're not really in a recession. Just like they redefine inflation, they redefine what a recession is. As the news gets worse and the facts get worse, they come up with more adjectives and nouns and pronouns and clever math to, again, avoid, I think, honesty and candor. What we already know, we're in a recession. A recession will help fight inflation. And that's good for, I guess, Uncle Sam, but it's certainly bad for the man on the street. Again, there's a disconnect between policy and being a fiduciary to the people you're supposed to be leading. If you can't be honest with them about inflation, if you can't be honest with them about a recession, they can't be trusted. And again, that's neither left, right, nor center. I think the American people or the German people or the French or the European people, their central banks are ready to hear the truth. What they already feel and see on the streets, we're not seeing in the official CPI numbers. We're not seeing it in the official recession announcements, but we're in a recession. A recession is intentional. It is a way to fight inflation. So we could go from inflation to a disinflationary cycle, sadly, not through super intelligent central bank policy, because there's no room left for policy anymore. There's too much debt. They don't really have any good options left. The only last resort now is a recession, which we're sailing straight into, unfortunately.
You've mentioned in a recent article that the rate of inflation is actually above the rate of interest rates, right? And this is an environment that should be great for gold. So real interest rates, if you subtract inflation, is negative. But we're not seeing gold rise substantially, at least in the last year or so. So your perspective on what is happening in the precious metal markets right now?
Well, as I wrote recently, the Fed may be empirically wrong, but they're never wrong. In other words, they're always right. Because at the end of the day, whether you agree with the CPI or whether you agree with the reported real rate of inflation, which is highly negative, we have negative real rates. But if they're going to report them officially as positive based on duration of bonds and models and surveys, if we have negative real rates, but it's not officially reported that way. Even though they say we're at a neutral rate. So whether they're honest or not, that is the official rate. So that is a headwind for gold. Absolutely. The key headwind for gold, though, aside from the, I think, creative math in the Bureau of Labor Statistics and the Fed, the real key headwind for gold has been the strong U.S. dollar. And this combination of rising or relatively stronger rates in America versus other parts of the world and a stronger relative currency is an undeniable headwind for gold, and that has certainly affected the gold price of late. But again, the reason why that too is very short-lived as a headwind to gold and silver is simple, because if we are heading into a recession empirically, based on GDP now forecasts and consecutive quarters of negative growth, if we're in a recession, there is no example in the history of economics, modern or pre-modern, where you can get out of a recession with a strong currency and high rates. Even the Fed knows this. And as we're heading Titanic-like towards this recessionary iceberg, they have no choice to fight a recession but through lowering their rates and making the dollar weaker. This policy temporarily of raising the dollar through rising rates and attracting foreign money into our markets to keep us afloat was short-lived. And it's going to be short-lived. It's already starting to turn. But when we hit a recession, there is no way out of a recession. It will be a long recession, not a short recession. But regardless of that fact, again, this isn't a gold bug argument or an anti-American argument or a left or right argument. It's a mathematical argument. As we head empirically into recession, our central banks, our policymakers, regardless of their politics, are going to be stuck with the only option they have, which is to weaken the dollar and reduce rates to get out of a recession, however long or painful that recession is. So Main Street will suffer, markets will suffer, the dollar will have to come down, and rates will have to come down. And that truly is the optimal setting for precious metals. And so again, it's a patient course. I know people are tired of hearing be patient. I think gold in particular has outperformed other asset classes, but it certainly hasn't reached its recent highs. That is typical of gold. It will surpass its prior peaks in the coming months, only because we're heading into recession. And whether you love or hate gold, gold loves a recession. And I don't see any way around that recession now. Santa Claus is not going to save these markets. There's no, other than clever adjectives in math and FOM speak, there's no way to avoid the obvious. A duck is a duck is a duck. If it quacks and walks like a duck, it's a duck. This is a recession. We have much higher inflation than is reported. And I think more and more investors, whether they're bulls or bears, are catching on. It's not about being cynical or being anti-American. None of those things are good. It's just about being honest and being blunt. And that's missing right now. And I think I understand if I were a central banker and I was trying to keep calm and keep the markets calm and try to prevent, an acceleration of these disastrous macro circumstances we're in, they think they're probably doing the right thing by calming the investors with words and fudged math. But at some point, the reality on the streets, the reality in your job, the reality of the grocery store just supersedes all that. And you realize we're in a recession and inflation's killing us.
Now, when do you think that realization will hit? And when is the Fed going to actually pivot to lower rates because of that?
No one knows. I certainly don't know exactly what month they're going to start going full on official dovish. In a sense, what happened yesterday was already, if you look at the language, the semantics of Powell and the carefully worded notes that, market and fund managers literally will read the transcripts looking for those key words. In a sense, he was already signaling a pivot yesterday by talking about softening growth, because he is aware that GDP is coming in negative this quarter. And Powell is aware that we're heading into a recession. And as I said, in a recession, you can't have rising rates and fight a recession. The Fed has to worry about inflation, but it also has to worry about a recession now. So they're two different policies. You can't raise rates in a recession. You can raise rates to fight inflation optically, but you can't do both. You can't fight inflation and a recession. And as I said at the beginning, the Fed deep down isn't really wanting to fight inflation. It's a tool for them. They don't want to see inflation go away, because inflation helps them get out of debt. Debasing the currency is good for them. And as growth slows, as GDP slows, that gives them the excuse to pivot dovish in the next meetings and to slowly change the narrative from hawkish and chest puffing to, hey, we're concerned less about inflation now and more about slow growth. So we're going to have to temper down that tightening and go towards more easing. So to answer your question, I think yesterday was ironically already a dovish signal. It'll be very interesting how dovish they go in the next meetings. But again, this notion of 3.8% by 2023, as Ronnie and I have said, I think is completely fictional. And now they'll have the GDP narrative and the recession narrative to justify the pivot. And that pivot, again, will be a lower dollar and lower rates, and that will be very good for precious metals. Absolutely.
Now, last time we had you on, we were talking about the move away from the dollar by many countries out there. And the dollar, has this world reserve currency status. So it's the top reserve currency in the world. But that has been slowly waning for quite a while now. And now we're hearing actually some new news. The BRICS nations are working on a new reserve currency. So that's Brazil, Russia, India, China, South Africa, possibly more. We'll see in the future. But your perspective on that and how that fits into this whole move away from the dollar.
Yeah, it's important to understand, as we talked about last time, that this de-dollarization process is precisely that. It's a process. It is certainly not overnight, and it's not the end of the U.S. dollar's reserve currency status anytime soon. What we're seeing, though, with these recent BRIC agreements is something that China and Russia particularly have been looking for over a decade, this slow desire to optically and realistically get out of having to make every transaction, whether it's for oil or whether it's for trade or whether it's for settling currency exchanges in dollars. And so what you're seeing in Brazil with the BRICS is absolutely a watershed. As our other advisor, Grant Williams, said, in some ways, the sanctions and the pivots of February 2022 were as much a watershed for currency markets as the 1971 August de-dollarization or the decoupling of the gold standard, So 2022 and 1971 are massive years or massive moments in time. What's happening with the BRICS, though, is, first of all, you're not going to see the yuan or the ruble replace the dollar anytime soon. There's so many reasons those currencies are unstable themselves, relatively still in some ways less indebted Russia than the U.S. and stronger in a relative basis than the dollar, depending on who you talk to in Europe or who their trading partners are. But for Brazil to do a trade with South Africa in yuan is probably not going to happen. There's not going to be a BRIC currency anytime soon. Each of those countries will make unilateral, bilateral agreements among themselves, so it won't be in a new type of BRIC dollar or BRIC currency. Not right away. There's simply too much distrust and too much debt problems in those respective countries to come up with a unified currency, in my opinion, anytime soon. What is important, though, is regardless of how these BRICS have unilateral trades, again, if Brazil is doing a trade with India, it's not going to use South African currency to do it. They're going to go direct. Each of those countries will have to do direct contracts, in my opinion. But what is really important is, regardless of how that slowly evolves in a floating currency scenario with the BRICS, what is important is already major powers are saying one thing we do agree on is we don't want to use the US dollar anymore, whether it's for oil or whether it's for grain or whether it's for a widget that we're going to put on a boat to send to country X, Y, or Z. We want to get out of settling that through SWIFT payment systems, which are dollar-based. And that is a very significant signal to the US dollar's hegemony. Again, not the end of the world reserve currency overnight. We are still the best horse in the glue factory. The dollar still is. But what is happening, and especially as we pivot into a recession to become more dovish and our currency gets weaker, and as we have more geopolitical unrest and more inflation and more social unrest, all these things converge to slowly point towards less and less respect for the dollar. And ultimately, what the IMF has been signaling since 2020 is a new reserve currency in the form of central bank digital currencies. Again, even a central bank digital currency, an e-yuan, or an e-yen or an e-dollar or an e-euro, that's not going to be overnight. That's not going to be easy, and you're probably not going to get the support of the BRICS. You're not going to see China in that situation or Russia now in that situation. So there's so much uncertainty out there that for me to say when and how this ends and how it will be resolved in what particular moment in time is impossible. What is clear, though, is the genie can't be put in the bottle now. Even if there was peace tomorrow in the Ukraine, Russia and China no longer trust US FX reserves. They no longer trust the SWIFT system in Europe. They've just seen what happens when you weaponize a currency. And now they're looking for new friendships, new partners, new sandboxes to play in. And that's not going to change. That's an irrevocable watershed in the currency markets. And so ultimately, that's ultimately bad for the dollar. It weakens the dollar's status. It weakens the faith in the dollar. And as I've said, faith is impossible to measure in time. But there is a slow unwind in faith in the US dollar for numerous reasons. Inflation isn't helping. A recession is not going to help. And geopolitical tensions certainly aren't helping the US dollar. So it's really a convergence of a lot of factors right now.
It seems like we're having then two situations that are going to be bad for the dollar at the same time, where we're seeing domestically, we're seeing inflation, we're seeing, the devaluation of the dollar. We're going into a recession. So there's probably just going to be more of that. We're going to see lower interest rates. We're going to see more money creation, which will weaken the dollar. And at the same time, the world is slowly rejecting the dollar. So how does this all end?
It's a very good summation, Elijah. I mean, again, here we are. We have the perfect storm of inflation fought with a deflationary recession and geopolitical risk that's led to de-dollarization. None of those things bode well. And the question is, which one of these will weigh the highest or the heaviest on the shoulders of Uncle Sam and the national economy? I don't think this will be a short and painless recession. If you go back to the von Mises Austrian school, the bigger the debt, the bigger the crisis that follows. We've had decades of record-breaking all-time debts. So the hangover that comes from that debt party is going to be more severe than prior hangovers. Mathematically, I don't see a way around it. So if you just look at the debt crisis and the inflationary policies used to fight it, and then you talk about the recessionary forces of a weaker dollar, all the things you summarized, I don't see a light at the end of the tunnel anytime soon for this. We can pretend and extend. We can go dovish and ease and support markets by debasing the currency. But again, that's running uphill with roller skates, because if we go into easing, that debases the currency. If we go into tightening, that crashes the market. And we can't tighten and raise rates into recession. And since we are empirically in a recession, it's like when you're in combat. You're in combat. There's no point in thinking about your mother's apple pie now. You can dream about it, but really you need to know how to load your weapon, clean it, and keep your head down. There's just a point in time where you have to stop pretending that things are okay and accept the reality in front of you. And again, this is not just the opinion of a gold executive or a macroeconomist with a negative view. There are ways you can be bullish in this market if the Fed wants to print and extend and pretend, but you can't avoid the consequences of debasement. So if we're going to be honest, regardless of the asset class that you choose, and personally, of course, for me, it's precious metals. Even if you're a Bitcoiner or you're an options trader and you think you can play the volatility, we all have to agree that we're in combat now. We're not at home. There's no more apple pie. We have to say goodbye to that and face the reality in front of us. And more importantly, our leaders, financial and political, need to be honest, like you would at a family conversation. Honey, we're in too much debt to go to Disney World this year. This is what we have to do. I think a leader can tell the nation, look, we're in a recession. We have a real inflation problem. We're going to have to weaken the dollar. We're going to have to lower rates to get through this recession. And there's going to be pain. We all know that, but someone has to be honest and say it. Germany's in no better scenario. France has a massive debt problem. The European Union has problems here. Italy is basically disunified itself. Its coalition government is collapsing. The French and the Germans are tired of paying for Italian bonds. So there is a lot of negativity out there. It's not just me trying to find negativity. It finds you. And it's time to, I think, accept that realistically. All those points you made about recession, inflation, and de-dollarization are converging simultaneously. I think the recession will be the most heavy influencer in the slow dying faith in the U.S. dollar and policymakers. I don't think policymakers are winning any hearts and minds by pretending we're not in a recession or not being honest about inflation. So I think as more people become informed, not pro-gold or negative gold, just informed, these things become more obvious. And any opportunity we have to speak candidly about this is important. If we get one or two more people to think about these things, doesn't mean go out and buy gold or silver or buy Bitcoin or buy some tech stock. It just means think about the honesty of our balance sheet as a country, just like you would in your family or your small business. Be honest. That's really what we need to be.
Matthew, thank you so much for your time today. Where can our viewers find you if they're interested in learning more?
Well, obviously, goldswitzerland.com is our URL for Matterhorn Asset Management. And, you can read all of our articles. Egon and I wrote a number of articles there. And we have a book, Gold Matters, that's just been released. We're hoping to get that out in German soon for German speakers. But goldswitzerland.com. We have a publication section there where all our recent thoughts week to week and our interviews are posted. So welcome people to come take a look.
Any last thoughts before we let you go?
Again, I think just be informed, be honest, question your own thoughts, bear or bull. And I think try and look at the math objectively. And that includes me. You can check my math or check our math and check your central banker's policy talk. Check their words carefully. But, at the end of the day, 2 + 2 should equal 4, not 2. And, when you have too much debt, it's not the time to buy a new sports car. It's the time to, unfortunately, tighten your belt. And as a country, we need to see that, honestly, I think.
All right, Matthew Piepenburg, thank you so much for your time, and God bless.
Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.